Alright, now we've reached the topic of leverage or the leverage ratio, which is basically the credit that the broker is going to give us for trading. Guys, pay close attention to these topics because we're not supposed to go over them in every single one of our trades. We don't need to calculate or consider these things every time. We just need to pay attention to this when we're opening our account. What type of account we choose from our broker and what leverage we select for our account. The choice of leverage amount is up to us when opening the account. So we need to understand what leverage we're choosing based on the capital we have. First, let's get familiar with the concept of leverage, which is the same as the broker's credit ratio. Look, guys, at that time, we said that one lot is 100,000 US dollars. Well, and we said that to enter a trade, it's not necessary for us to have that full 100,000 ourselves. And depending on the leverage, which is the credit we have with the broker, we only pay a portion of that money. Here we make that choice. Let's look at this with an example, friends, and calculate it. For example, the current price of euro to dollar on the chart is 1.5435. If we want to make a one-lot trade on this currency pair right now, one lot is equivalent to 100,000 US dollars. So 1.5435 times $100,000 equals how much? It becomes $154,350. But guys, we do not need to have $154,350 to make a one-lot trade. If our leverage was 1-to-1, then yes, we would have to put up the entire amount ourselves. But what happens here is that the broker comes and asks us, what kind of leverage do you want me to give you? In your account, what does that mean? Do you want this account to have a 1-to-100 leverage? Meaning whatever amount of balance you need for that volume of trades. You put up one part and the broker puts up 9 parts, or if the account is 1-to-400, what does that mean? It means that out of the total amount, $150, $4,000, and $350, you only put up 1/400th and the broker covers the rest. There are even leverages up to 1-to-1,000 available at brokers, where you only put up 1/1000th yourself. The broker covers the rest. In the next file, I'll explain in detail that choosing leverage is a double-edged sword. It can allow us to enter large trades with a small amount of money. Well, when we enter and make a profit, it's very sweet and very appealing because we can enter big trades with a small amount of money. But with big losses too, guys. Using leverage, it's a science, and we're teaching you this science. There are times when this same leverage can bring really good gains, or it can cause very big losses. That's where risk management comes in to help us. In the risk management section, based on the leverage of our account, we see what lot size we're allowed to trade, meaning with what volume we can enter this trade. So what do? We choose a leverage for the account. If we select a leverage of 1-to-100 and for $154,350 in EUR USD, where we're planning to trade one lot, we only need to provide 1% of this money. That's the concept of leverage. Now, let's continue. Let's move on to the value of each pip. Guys, the value of each pip, as we said, the pip is the 4th decimal place that we have in. For example, in the EUR USD chart, our pip value is at the 4th decimal place and our point value is at the 5th decimal place. So when we want to trade this, you multiply the price you have by 0.0001. That is the 4th decimal place. And based on the lot size, its value is calculated for us. Guys, the broker's calculator. What helps here so that we don't have to do these calculations and math ourselves every time. The broker calculators are available in every broker we work with. The broker's calculator very easily calculates for us which currency, which figure, and which lot size. It shows at what price you open, at what price you want to close, and how much your profit or loss is. This is so that we don't get confused about pips, points, and the volume we're using. We will talk in detail about the broker's calculator, and we'll go into the broker, into its calculator, and explain all these topics to you there thoroughly. All right, today we're going to open an account and deposit some funds into it. We want to get familiar with a few economic terms in English. The initial money that we deposit into our account, whether it's a real account or even a demo, it doesn't matter. The initial money we put into that account is called, in technical terms, balance deposit. Those who have transactions with foreign banks know that depositing money into their account is called a deposit, and withdrawing from the account is called a withdrawal. Well, here too, the money is inside the broker's account. For example, when we want to deposit money, let's say we want to fund our account with $10,000. Let that be our initial deposit. So basically, our balance or deposit is now $10,000. The amount we give to the broker at the beginning to open the account, that's how we get familiar with the first option. The things I'm talking about now are the ones you see in MetaTrader by pressing Ctrl and T as a shortcut key, or by selecting the terminal option from the view menu, or just using the shortcut itself. The terminal that appears on the screen in MetaTrader, you can see all of this in detail, and that's what we're discussing right now. What's inside it? There's an option showing balance, equity, margin, margin level, free margin, and various percentages and values. Right now, we'll look at these terms theoretically here on the PowerPoint, and then we'll go into MetaTrader and see them very clearly. We'll check each one by one in their respective places together, so let's go back. Let's get started. So, the initial amount we deposit into the broker, that initial money, the deposit, is our balance. Now, let's talk about equity. Guys, what is equity? How is it different from balance? Equity is basically our balance, but it's floating. What does that mean? Floating, it means the balance amount itself never increases or decreases on its own. We make a deposit once, right? For example, we deposit $10,000. Equity says, I consider myself the same balance that you deposited once. Whatever profit you make from the trades you open, I add that to it, or if you incur a loss, I subtract it. If you incur a loss, I subtract that. So if we want to know the formula for equity, what is it? It's the balance plus or minus profit and loss. If our initial balance is $10,000 and we're $100 in profit, our equity is $10,100. If we're $100 in loss, the balance is still $10,000, but our equity becomes $9,900. Okay, the amount of profit and loss is what is called equity, which is added to or subtracted from the balance. There are some other definitions in the control panel that we see in our terminal. First is the balance, second is the equity. Now let's move on to margin, free margin, and margin level, or our margin percentage. Let's take a look at it one by one. What is margin? Well, just like I told you before, to enter any trade, we need to pay a certain amount of money. And who determines this amount for us? The broker. For example, let's say we open an account with a leverage of 1 to 100 and we have $10,000. Now we want to enter a trade worth $100,000. So when we want to enter a $100,000 trade, or in other words, trade one lot and our leverage is 1 to 100, 1% of 100,000, that is $1,000, we have to put up as collateral to enter that trade, and the remaining 99,000 is covered by the broker. The amount that we have to put up from our account as collateral to enter that trade, what is it called? Margin. So here, we understood that margin is the amount of money from our account that gets locked up for that trade in the broker account. As you can see, it's the amount of money from the account that gets tied up for making the trade. It's called margin. What is free margin? Well, as the name suggests, free means available, so it's available margin. So the amount of money from our balance that gets locked up is for the trade we've made. Free margin means the rest of the money, the part that's available. For example, if our balance was $10,000, you made a one-lot trade, which is equivalent to 100,000 units, with a leverage of 1 to 100, meaning 1%. Our money was used for margin. $1,000 out of our $10,000 went for margin, so $9,000 remained. Now that remaining balance is free, and we call that available balance. That's free margin, okay? One point before I talk about the rest, let me tell you something, guys. It's not like we have to calculate these things for every single one of our trades. These definitions, these terms, or these calculations are done automatically. When we start a trade, it's written in our terminal. We're just explaining it once and for all now so you know what these are, what they do, how they're calculated, and whether they even matter in our analysis or trading. Or when we're doing other tasks, there's no need to calculate these every time. Because right now we're putting together a package for you that's completely comprehensive and covers everything in detail. Every event that happens in the broker, in your Meta account, we want you to be aware, so we're explaining these things to you once. Okay, let's get to the margin level section. Hold on. Let me give you a formula first. We said free margin is the remaining money that you can trade with. If we want to consider a formula for free margin, for example, if our balance is 10, the $1,000 we had minus the margin that was deducted from us to enter the trade, for example, we calculated $1,000. We paid this amount to enter that trade. Guys, we're not giving this money away for good. For this trade, that money is just frozen at that moment, the money we brought into the trade, until we close that trade. This margin is completely returned to us along with the profit or loss we make, the profit or loss from the trade. For example, let's say we have $100 in this trade. We make a profit. Now our free margin was $10,000 and $1,000 was deducted from our balance for the margin, so we had $9,000 left. We made $100 profit. So now we have $9,100. Now here we have free margin. Let's continue. Now we get to margin level. When we get to margin level, there's a formula. It says equity divided by the amount of margin multiplied by 100. When you multiply by 100, so as we can see, it's a number expressed as a percentage. So our margin level is a percentage value. And how is it calculated? It's calculated as equity. Do you remember what we said equity is? Equity was our balance plus or minus our profit and loss. Our profit and loss our profit is stable, and that small amount left is our loss. So it's a plus or minus from the balance, which gives us what? Our equity. This divided by what? Divided by margin. Margin is the amount of money that was taken from us for the trade. Times 100. Okay, guys, this margin level is very important. Why? Because a lot of people, by not knowing these concepts, sometimes make the right trade, but it ends up causing their account to get liquidated. The trade was technically correct, but the basic principles weren't followed. Let me explain. I'll cover this topic fully in the margin call section. Now here, when our account goes into loss, the balance is the initial deposit. Margin is the money that has been locked once. So the margin that's in the denominator can't be touched. Profit and loss. If we're in a loss, that's clear. And if we're in profit, that's clear too. It's obvious. But when the denominator of our fraction gets smaller, our result also gets smaller. That means our margin level percentage is actually decreasing. And when this percentage gets very low, the broker will automatically close our largest losing trade so that its margin is freed up and the rest of the account remains. Let's look at margin together. For example, in a standard account with $10,000 and a leverage of 1 to 200, we've brought an example here for you. In our account, we deposited $10,000 and chose a leverage of 1 to 200. We want to buy one lot of xauusd at the rate of 1.2716. How much margin do we need? Let's pay attention to this example. What does one lot mean? It means $100,000. The amount of money, the volume that will enter this trade, right? What does a leverage of 1 to 200 mean? It means you divide that 100,000 by 200. How much is that? The amount of money we need to put in is 100,000 divided by 200, which is 500, multiplied by the xauusd rate of 1.2716, which equals $635.08. So now for entering a trade. So for a $100,000 trade with 1 to 200 leverage on xauusd, you only need $635. So even with a $2,000 account, we can manage a quarter of it. We can enter a $100,000 trade. We'll work with these concepts in MetaTrader and we'll review them there again. The video is theoretical so that we know what margin call or stop out means. Hopefully none of you will ever experience it. What does it mean? In simple terms, a margin call means losing your entire capital. How do we end up with a margin call or lose all our balance in a trade or in a position? In the accounts where we have open trades, in which trade do we lose everything? Let's review what happens together, because by being aware of these topics, we can prevent it from these issues. Well, when our losses increase and a lot of margin is used up, it's clear what happens as the losses grow. It means we are trading incorrectly. When a lot of margin is used, it means we are increasing the number of our trades and using more margin. We lose the deposit of that account we had. What happens is that our margin level, which is expressed as a percentage, let me bring up its formula here again. Our margin level, which is a percentage, is calculated as equity divided by used margin multiplied by 100. The margin is in the denominator. With the number of trades or by choosing the wrong leverage, it gets heavily used up. So the denominator is getting larger. Guys, just think of a simple fraction. When the numerator is 10 and the denominator is 2, the result is 5. If the denominator increases, say from 2 to 5, the result of the fraction becomes 2. The value of this fraction is getting smaller. When this result gets smaller and we calculate it correctly, we multiply it by the correct value and reach a number that in different brokers, this number is considered differently. In order to close your account in loss, and as stated in the broker's terms beforehand, for example, my margin call is at 70% or at 30%. That percentage refers to the remaining margin level. In this calculation, if the margin level drops by 1%, that is the margin call situation. It means increasing the equity. Now, whenever this specific situation occurs, just before the account is finally closed, it will begin to flash and blink its warning light repeatedly. What does that mean? It means it's warning us to increase our equity. So what was equity? Equity was the balance. Let's write it here. Equity was the balance plus or minus the profit and loss, right? At that moment, we can't touch the profit and loss. Either we have to close the trades at a loss or we can't open new trades because we don't have any more margin left. Music. But here we can increase our deposit. If we're really confident about our trades, I'll say it again. We work with the risk management strategy that we're teaching you. Hopefully you'll never have to deal with this part, but do you know what it means? It means your equity is high. If this is done, if it's not done, and the margin level drops even further, the trades with the highest losses will be closed in order until there's no margin left for us at all. This is the topic of a margin call. Okay, let's move on. Now let's talk about swap or overnight interest. Look, friends, swap or overnight interest is basically the interest rate, which in our religion for Muslims is forbidden. It's the same interest that's charged on money. That's why brokers who work with Iranians usually have an option for their accounts called swap free, meaning without swap for a limited period, like 3 days, a week, or 10 days. But in its own way, or in Islamic accounts, swap is generally free. But what is it exactly? Let's get to know it first. I should say that the issue of swap applies to trades that are going to remain open for more than 1 day. That is, trades that last more than 24 hours. They go into the next day, meaning they complete 1 business day and move on to the following day. But for those of us who want to scalp in the market or take short-term trades or catch quick moves in the market, the presence or absence of swap doesn't matter at all, whether the account is Islamic or not. We don't get hit by swap. Swap can be positive or negative, meaning we can either pay swap or receive swap. In fact, there are some traders based on different criteria who actually trade specifically for the swap. They choose a currency pair based on the swap and enter trades accordingly. But now let's get more familiar with swap through an example. Guys, brokers operate through something called CFDs. What does that mean? It means, for example, if you want to enter a trade with 1 lot, that's $100,000 at that moment. It's as if they're taking a loan from a bank in that country, and then at the end of the day, they have to pay the interest on that loan. Now, if the interest here is positive, that interest will be deposited into your account. If the interest is negative at the end of the day, that interest will be deducted from your account. We're talking about overnight positions. For example, let's look at USD JPY, the US dollar against the Japanese yen. Let's assume, just for the sake of explanation, the bank interest rate in the US is 2.5% annually, and the bank interest rate in Japan is -0.1%. When you make a purchase, that is, when you click buy on USD JPY, it means you are selling yen. Guys, when we click buy, we are buying the first currency and selling the second currency. At the same time, if we click sell, we are selling the first currency and buying the second currency. So here in buy and sell, I can further explain this topic to you, that in buy and sell, how do we buy and sell at the same time? We are buying a currency. Even in a sell trade, we are buying something. We are buying something in exchange for selling something else. This is what the Forex market is. This is the interaction between 2 currency pairs. When we click buy, the first currency is the base. We are buying the first one and selling the second one. When we click sell, we are selling the first currency and buying the second one. So when we are buying, it means we are selling Japanese yen and buying US dollars. In this case, the swap rate equals the difference between the two, and it's negative, so it should be positive over the year. If we make a sell trade on this same currency pair, it means we have sold US dollars and bought Japanese yen. The swap rate is negative, so we understood that in USD JPY, when we buy, that is, when we click buy, we can receive a positive swap. When we click sell, we might have to pay a negative swap to the market. That wraps up the discussion on swaps. Well, in the next session, we're going to move on to the trading platform itself. That is, we'll enter a broker and set up a trading platform account from there. First, before we enter a broker, we need to go through a few steps. We'll talk about brokers. Let's see how we should choose these brokers. How are brokers regulated and which brokers are reliable? After we've chosen our brokers, we'll move on to how to register with that broker. So what do we need to do ourselves? We need to verify our identity with the broker by providing our phone number, email, first and last name, passport, an identification document, and a proof of residence document. We get verified by our broker and then proceed. In our broker's dashboard, there is a trading platform, either that broker's own platform or now MetaTrader 4 or 5. These platforms are available within these brokers, and we download one of them. After downloading our trading platform, we create a demo account with the broker. The username and password, that is, the account number and its password, are provided to us. The account number is given by the broker. We set our own password, then take it and log into the MetaTrader we installed. This is called running it. We add our account to it and start customizing our MetaTrader environment. After that, we get familiar with the trading timeframes and candlestick recognition. Welcome to the future.